Hey everyone, welcome back to the Positive Money Project. Today we are here with Deon Norris of the Norris Group.
Yes.
And we're going to chat a little bit about what we've both been up to, what we see happening in the markets, and also a little bit about how to prepare yourself for year end and next year's taxes ahead of the end of 2025. Hey Deon.
Hello, Julie.
How's it going?
Pretty good. So, Julie, thank you again for being on this episode with us. And we have very similar things that we're doing, and we do work together and our paths cross. What are some of the things that you've noticed in terms of kind of taxes towards year end with some of your clients that the public should know?
Yeah, I mean, as far as taxes go, I see one of two things. People who are very prepared and people who are very ill prepared. People that, haven't been tracking their taxes, haven't been doing their estimates, and year end comes and they get slapped with a big old bill and they're panicking.
Yeah.
And I'm sure you see something similar.
Yes.
At the Norris Group.
Yeah, definitely.
But yeah, and then, it can obviously cause like a really big headache and burden on my clients when they get to the end of the year or the following year and they are, their budget is not where they thought it was going to be.
Yeah.
Right? So, how do you, help prepare your clients for stuff like that?
Well, I think what we're doing right now is we're making a strategic shift with the focus of what we do and how our clients think about taxes. Some of what we've noticed is like you said, some people think taxes are once a year, so they wait to the very last minute to get prepared. And what we're out doing is trying to educate clients to let them know that taxes happen year round. So there's decisions that you make in January that are going to affect you next January, vice versa. Things that happen in summertime are going to affect you during tax season. So what we're really pushing is more of tax planning throughout the course of the year, so we can have multiple touch points and we can get people prepared for the end of the year heading into tax season. And what we found is the clients who understand that are a lot better prepared and a lot more knowledgeable. And taxes, or I say tax season, isn't a surprise for them because they already know what to expect.
I guess I had a client recently who was trying to decide, on how to best project her taxes for the year. And she's a small business owner, entrepreneur, and she asked me, should I try to project them and, pay them monthly or pay them quarterly or put the money away and save it? I gave her my advice, which was do what's best for you. I think you should, and then I told her I would save the money up so you can earn interest on that or earn market gains on that until your tax bill comes due. That was my advice to her.
Okay.
But what do you tell your tax planning clients?
So the rule of thumb is if you're self-employed and you're expected to have a tax liability of at least $1,000 to file quarterly. And also W-2 earners as well, if they're a dual income household, should also file quarterly in addition to what comes out of their checks. But generally what I tell my clients is as long as you are meeting that 90% or 110% of your previous year AGI, depending on your income level, regardless if you do it quarterly or at the end of the year, whatever works best for you and your budget. But also sometimes it may make more sense to take that money, set it aside, invest it, gain some interest before giving it over to the IRS.
So I can see the benefit of, investing the money and paying it all at the end. But what's the benefit from your perspective or from your experience with your clients of paying it on a quarterly basis or in advance? Or is there?
There is. And I would say it is the human perspective and sticker shock of when you see how much you owe if you didn't make any estimated tax payments, being that that's a year's worth of taxes that you're paying at one time versus if you break it up, it's a lot more digestible.
That's fair.
So that is one thing I advise clients, that just be prepared if you choose not to do it. Expect that number at the end of the year to be very high because it is entire year's worth of taxes you got to pay at one time.
Right. So it's kind of more of like a psychological / discipline thing versus makes sense.
Definitely.
Makes sense.
All right. So we talked about taxes, which play a huge part in everyone's lives. Regardless of what we do, we're going to pay taxes.
Right.
What are some of the things with your clients that you're trying to help them in terms of how taxes fit into their overall budget and their financial picture?
As far as their overall budget and financial picture, I always try to help my clients, reduce their tax bill as much as possible. There's a lot of things that you can do, as you know, to ensure that your clients have, try to pay Uncle Sam as little as possible. Obviously, being on time when the bill does come due and keeping track of that is important. But there are a lot of accounts that just not even a small business owner, but just like an everyday W-2 employee can do to minimize their taxes. One big thing is saving for retirement. We have a lot of tax-friendly, I'll say, accounts available to us, 401k, for example, as well as the HSA. I think people sleep on the HSA.
Yeah.
If you can afford to have a high deductible health insurance plan, putting money into an HSA, qualifying for that HSA and putting money in there gives you that triple tax-free money that you can invest tax-free, let it grow tax-free, and then withdraw tax-free for tax purposes. Yeah. And when it comes to the year end specifically, I think, people often get confused or mistake the HSA and the FSA for each other. So I would say it's also really important to keep an eye on that, right? Keep an eye on, knowing what type of account you have, knowing the tax benefits, and knowing, is that money gonna disappear at the end of the year or not, so you can plan appropriately. Yeah,
those are all very good points to bring up with clients, and we do the same thing as well, especially with the HSA. I tell clients, especially on the younger side, is look at it as another retirement vehicle for you.
Exactly.
Granted, you put the money in there, you max out. If you're healthy, you never pull from it, so it just builds up over time. Eventually, when you pull it out, if it's not for medical purposes, you do have to pay a penalty on it.
You do.
You do, and I let them know that.
Right.
You will pay a penalty, but depending on other income sources, that penalty can be extremely low when you're in retirement, depending on how much other income they have. So that is one thing that I do bring up. And then also for 401k too, and this is one thing, especially with business owners, that we're educating them on, is the max you can do is $23,500 as a W-2 employee.
Yep.
But what I tell my business owners is you can do that as a W-2 employee, but on the flip side, as a business, you can contribute an additional amount, not to exceed, I believe, $67,000 or $70,000 in 2025. So it is that little extra, being a business owner, that can actually benefit you a lot more, because you're able to put a lot more towards these same things versus your W-2 employee.
Exactly. And on that point, I will say I tell my small business owner clients this as well, and a lot of them are shocked to learn this. They don't really know about that benefit of being self-employed, and it surprises me because I'm like, this is a huge benefit for you. You're literally doubling your investment, so it's really important to keep an eye on.
And one thing that I do help educate clients on, especially the tax planning clients or higher income earners, business owners, is the code is fundamentally set up to benefit real estate professionals and business owners. If you are a W-2 employee, it is not set up for you. You are taxed the highest and the most because the law limits what you can deduct from your income, versus when you lock or tap into these other sources of income, passive income, like I said, being a business owner, etc. You are taxed completely different because the law treats that money differently and allows certain deductions. So understanding that, I believe, has helped a few of my clients make better decisions, knowing that what I can do over here on the W-2 side, I can do even more on the business owner side. So let me get on this side and start taking advantage of those things.
Yep. I think the hard part is like knowing what those key points of difference are, and then being able to take advantage of each of them, whether you are a W-2 employee or a business owner. I think that's what a lot of clients struggle with, is like knowing what rules, laws apply to me, and then which don't, and how does it change over time depending on which side of that income I'm on. Yeah,
and that's also why we go by the term advisor, because there's a connotation when you say like a tax professional or a tax preparer, that's all you do is just fill out a tax return, where we do so much more that we can advise you on not only filling out a tax return, but how to best save on your taxes, and then how to create a budget, how to do all these other things. That's why we're going by the term advisor now, to unlock that in someone's mind that we can do a lot more than just taxes.
Right. So you're trying to switch your business more to the tax planning and help your clients think about these things in advance versus just it's February, March, and we got to scramble to get the taxes done. That's
Yeah.
pretty exciting.
Yes, and one success story so far that happened recently in the last month is we're helping a client wipe out their 2023 and 2024 tax liability completely. And I think in totality is probably about $1 million between the 2 years that they paid in taxes.
Wow.
And then we're going to start working on wiping out all 2025. The way we're able to do this.
Yeah, what are some strategies you're using? Go share.
The way we are able to do this is the benefits of the tax bill that just passed in July, and using the codes to a benefit. So this particular client is invested in wildlife, exotic wildlife.
Okay.
So you think of buffalo, zebras, giraffes, things of that nature, right? So if you are an investor, but you are in it for a profit to actively breed and trade these animals, the IRS allows you to use bonus appreciation. Now, the cool thing with livestock, it is literally the same code as equipment, because that's how the IRS views livestock is equipment. As long as you're in the purpose of creating a profit and selling the animals. So you're able to buy animals and get bonus appreciation.
So let me ask you this. How do you invest in zebras? Because I'm sure everybody out there watching is probably wondering.
So yes, we work with a few companies that actually started this industry about 10, 15 years ago. So they pioneered how you do this. So you are technically investing into a company and becoming a general partner in that company that is then buying that livestock.
Okay.
So that is how you are, quote unquote, investing in it.
Got
and
it.
There's other requirements. I'm not going to get too much into it that go along with being able to activate those losses from passive to active that you need to meet. But it is an active investment that you are actively participating in, the buying and selling of these animals.
Interesting.
Yes.
Interesting.
Yeah.
I'm sure the farmers lobbyists had something to do with this tax code, but that's really good
definitely.
to know.
That's just one example. There's things with land, there's cost segregation studies, 1031 exchanges. Pretty much you name it, we can do it in our firm, because we have built out a network all across the country of people who specialize in these really niche areas that we're able to bring to our clients that we weren't able to bring before. And that's the value of networking, is just growing out our network, because we can expand our capabilities and bring more services to our clients.
That's amazing. That's amazing. So as far as year-end tax planning, what are some tangible, sort of action items or key things you think our listeners should be doing to prepare for year-end, whether they're business owners or individual W-2s? What do you tell your clients? What's the list of make sure you do these things before the end of the year so that you're well prepared come April?
Yeah, what I tell everyone first is, regardless if you're W-2 or business owner, we have to do some type of projections for you. So based on your income or expected income, let's project out what your tax liability will be. Once we understand that, then we can start making suggestions whether, hey, why not max out your retirement in these last 10 or 10 paychecks that you have during the end of the year, or contribute to your HSA, or do these other things. But without projecting out and fully knowing what their tax liability will be, it's kind of hard to pinpoint exactly what we should tell them.
Right.
But I'll say start out with projecting out for the next year, and you can generally do this around August timeframe is when we try to do to give us some leadway for the end of the year, and that way we can make those strategic decisions per client.
Yeah, that makes sense. That makes sense. So I guess on a larger scale, what are you thinking for 2026 as a whole? Like, we're thinking about the economy. I know you're in DC. The whole political landscape is always shifting, especially nowadays. What are you thinking for 2026? Like, what do you think is going to happen?
So I will caveat this with saying I'm not licensed to give any investment advice.
Not an economist.
Yes, I do not have my serious license. I'm not an economist either. But reading the tea leaves, if you're invested in the market, it's going to be a very good year in 2026. And there's a few factors.
What makes you say that? Yeah.
There's a few factors for that. One, regardless of the information that's coming out from the government, there is a job decline right now. More people are losing their jobs, and people are getting them. So that's number one. And then number two, you have inflation, that which is rising. Whether or not tariffs play a part in that, which they do, inflation is rising, and tariffs are playing a role in that. But you have the Fed, and particularly Jerome Powell, who's the Fed chair, who they're at a crossroads right now. When I say they're at a crossroads, meaning the Fed, the Federal Reserve. They're at a crossroads right now because they have a dual mandate for the U.S. economy, and they always have, and that is one, to keep inflation low, and to support job growth. Historically, looking at things right now, both of those are going in the wrong direction right now. So inflation is getting higher, job growth is stagnating. Things that they would normally do, i.e. lower interest rates, etc., to offset one or the other, is kind of going to lead to a situation where there may be stagflation, that some people say. That may result, but the reason that it's going to be a good year is they have to cut interest rates. So the Fed's going to lower their interest rate. The prime rate is going to drop, which means lending is going to be cheaper. When lending is cheaper, that spurs investment, which means the stock market is going to explode. Because if you ever heard the term quantitative easing, and this is something that the Fed is going to do, and they've kind of preempted this a few years ago, where essentially they're going to print money, and they're going to pump money into the economy to boost the economy up and decrease inflation. Right now, it will be a great time to get in for any type of stocks, investments that there are, because that is what's going to happen in 2026. You can see it after COVID, and you can see it after the Great Recession in 2007, 2008, where the Fed did the same thing. It's quantitative easing, pumping money into the economy, artificially keeping interest rates low. The post-recovery boom was substantial, and each time it's gotten a lot better. It's just this time some of the circumstances causing it are man-made, but the same results are going to happen.
And we hope.
Yes, we hope. So it's definitely a good time to get invested.
Yeah, so your take is the stock market, the stock market's on sale right now.
It is. It will be on sale, but on the flip side, affordability with housing, that's going to have it's not going to get easier, I'll say that.
Yeah. I mean, the housing affordability thing is rough. It's rough. Speaking of that, what are your thoughts on the 50-year mortgage? I just had to. I'm sorry, I didn't mean to flip topics, but
no, that's a good segue. I would say the only way that will work is if there was a crash in housing prices. Would be the only way that can work, and I mean housing prices basically decreasing by like 75% for that to even make sense.
Why do you say that?
With the 50-year rate, granted, it will bring down your monthly payment.
Your monthly payment, yeah.
A couple $100 right now, but you're paying $300,000-$400,000 more based on the median price of a home. In order for that, knowing that, in order to offset that, home prices would need to decrease substantially to ensure that you're not paying more in interest. I mean,
I've seen a lot of different analyses used in different hypothetical scenarios, and a lot of them show that you would actually be paying nearly double for a home.
Yeah.
And a lot of that, like you said, is going to go to interest. I think it's just, it's sort of amortizing anything over a longer time period. Yeah. You're going to pay more in interest, and it's going to take you forever to pay it. People thought the 30-year mortgage was crazy too when it first came out.
Yes.
But just looking at people's lifespan, a 50-year mortgage does seem crazy. And obviously, when at the end of the day, if you're paying double for the same property, it really doesn't make logical sense. But I think if banks and other lending institutions make this available, there will be some people that, I don't want to say fall for it, but that opt in for a mortgage over that time period.
There will be, unfortunately.
Yeah.
And again, like you said, when the 30-year mortgage came out, people thought that was crazy. But if you knew how mortgages worked before the 30-year mortgage came out, you would think that was even crazier.
Yes, that's true. It was an improvement over the existing system at the time.
For those of you that don't know, the 30-year mortgage came from FDR in a New Deal. Before that, you had mortgages 3, 5, or 10-year term, and it was either interest-only payments and then a balloon payment at the end of that term. So,
and they weren't publicly available to the public usually.
Yeah,
you had to buy into what do you call it,
A cooperative?
Yeah, a co-op.
Yeah.
Exactly. Thank you.
Yeah. So the 30
And so
year
it was
mortgage.
prohibitive.
Yes.
So it made it very difficult for the general public to be able to purchase homes.
Mm-hmm.
However, you had to really be able, the affordability factor wasn't really an issue because in order to qualify to buy, you really had to show that you could afford it.
Yes.
But so the 30-year mortgage made it more accessible,
Yeah.
which was good, but also
Definitely.
a little bit risky.
Definitely, because you have banks that are holding on to that note for 30 years versus the 10 years that the max was before. So that's why interest. That's why when you look at your payments, you have the amortization schedule. You're front loading interest because they want to make sure they get their money back because they have that liability they're holding on to.
Exactly.
You mentioned something a little bit earlier that some people may fall for the 50-year mortgage, and that kind of speaks to another point: financial literacy.
Yes.
And that is something that I've seen that definitely needs to be taught in schools.
Yes.
And the general public needs to be educated on financial literacy. What are your thoughts on that?
Oh my gosh, I 100% agree. Something that's very close to my heart, and the whole reason that I started the Positive Money Project. Yeah. I do think that there's a lack of financial education in the United States for sure, but in a lot of countries across the world. I think that it's something that should be taught in school. I'm seeing it more now. I've had a couple of friends tell me that their kids have like Finance 101 offered, but it's still, in a lot of cases, not mandatory, and in a lot of other cases, not even offered.
Yeah.
And I think it's something that we're slacking on in the US. And I think platforms such as YouTube, TikTok, Instagram, all these platforms that you and I are both on, putting these messages out there. And I know a lot of other financial planners, coaches, and financial literacy advocates putting out content and information on nowadays. I do think the accessibility of that information on the internet is definitely helping with the problem, but I 100% agree that it is still a deficiency.
Yes. I would say that is probably the number one thing that gets a lot of adults into trouble is not having financial literacy.
100%.
Not to say people are illiterate, but when it comes to finances, it just means knowing how money and credit works and using it to your advantage.
Yep.
And there's a lot of people who don't understand that. I was recently scrolling on YouTube and there was people complaining about $1,000 a month car payments, but you put zero down on a vehicle and you finance the entire amount. And then not only that, there are luxury vehicles that these people were getting. They're complaining about the monthly payment. And my first thought was, what did you expect was going to happen when you're living above your means? If $1,000 a month car payment to you is a lot of money, then you're clearly living above your means. First and foremost, but where were the calculations on how much this is actually going to cost? Because when they say sign here, you don't have to pay anything right now, or what gets a lot of people is, we can roll into the loan and you don't have to pay anything. You pay it over a long period of time, but not truly understanding what they're rolling into the loan. They're actually paying a lot more interest on, where it'll be cheaper. Let's say, even for a home closing costs, it'll be cheaper to pay the closing costs out of pocket than to roll into a loan.
Right.
But there's a lot of people that see that upfront cost, but don't understand the cost benefit that comes with rolling to the loan and what you're paying on it truly, versus taking a one-time, essentially, and I'll say not a hit, but an investment now to pay less over time.
And I think for a lot of people that make those types of decisions, like let me roll this potential upfront payment into a longer term, into the loan, the mortgage, whatever it might be, a lot of them are making that decision because they financially maybe can't afford to make that upfront payment. And that leads back to a bigger problem, which is a lot of people are overextending themselves when it comes to mortgages, car loans, just in general. And so when they go to make that decision, it's not really a decision. A lot of times it's like, well, the only way I can afford this is to do it this way. And then for those who can afford, to make that upfront payment, they might not, like you mentioned before, not have the financial literacy or the education or experience to know what exactly the trade-offs are to be able to weigh them appropriately. And I think that a lot of that leads back to the shame that is surrounding not knowing these things in our, in our country, in our society. You're just expected to know. No one teaches you.
Yep.
No, there's no formalized training, but you're just expected to know.
Yep.
You tell somebody you have a bad credit score, and it's like shame, shame, shame on you. But why do you have a bad credit score? Because you took out a credit card and misused it when you had no idea what a credit card even meant. You know, you had maybe a parent or a family member put your name on a bill that you didn't know about, and then they never paid it.
Yeah.
Things like this happen all the time, and no one really talks about them. And when you are in a bad place financially, or you have a big financial decision to make and you're not really sure how to go about it, just from working with my clients, I've experienced like a lot of them have a lot of shame, or they don't want to talk about it, they're avoiding it, and that's just something that I think is also an issue with financial literacy in our country.
Yeah. And you mentioned shame. That's one thing that I've seen too, is people feel they should have shame, and no, there's no reason to have shame, because a lot of times things that you know about finance are passed down through your family. So if your family wasn't very well off, or didn't have a financial literacy to pass down, it's no fault of your own, because they didn't know either. So now you're at a point where, you're trying to play catch up, but at least you understand how things are working now, so you can make better decisions going forward.
Right.
And you can always fix what happened in the past. It's going to take some time to fix it, but it can be fixed. And I'm a living example of that. So before I went to the military, I had 14 credit cards maxed out. Literally 14.
Dang.
And I was behind on every single one of them. And no lie, I remember this was 2011, before I went to the military. I was getting 60 to 70 calls a day. And I distinctly remember this because my phone was always going off. And those from creditors.
Yeah.
Wanting their money, rightfully so. And I made the decision then that I would never be in that situation again. So when I joined the military, I paid off every single debt that I owed. I paid off. And I've never been in that situation again, because and even me at the time, I had a accounting degree, so I understood and I knew better. But the circumstances dictated, just like you said, I was in a previous relationship, things were happening, so circumstances dictated that I had to do certain things in order to afford a lifestyle, because I was living above my means. That has made me better, because I can relate to people, because I understand how, excuse me, one decision here can have a cascading
slippery slope.
Can have a cascading effect, and just being understanding that it's going to take time, and it's nothing to be ashamed of, but at least we can unlock the knowledge and give it to you, so you can make better decisions going forward.
But that's a really good point. Like even somebody with an accounting degree who knows better, still fell victim to making poor financial decisions, ending up in a spot which they could have been ashamed of, and you had to put in a lot of work to get yourself out of that. So, and you buckled down and you did it, and you're open enough to talk about it now, but there's a lot of people that wouldn't. They don't know how to get themselves out of that situation. They end up in the situation, and then they're scared to ask for help. So
And one thing I realized during that time too is I knew about the credit scores and everything, but I really started to understand how the credit scores are made up and how I could manipulate it in my favor to boost my credit score.
That's good. Yeah.
Fundamental understanding. Yes. Make sure you don't have any late payments.
Right.
But what I also understood at that time is my credit utilization. So now I've applied for credit cards that I don't have no intention to use, but it's boosting my available credit limit. So those that I do use on a daily basis, the overall utilization is a lot lower.
Yep.
And then also what I realize as well is sometimes it may make more sense to get a loan, pay off the credit cards, and pay it off over time. And I'm able to manipulate my score, knowing what I want to do in the future.
Right.
So it's a way that I've always kept it since that time. I've kept it in the high 700s, 800s, is knowing how to manipulate the score in my favor, knowing how
it works.
Yeah, how it works.
Yes. So for people that don't know what a credit utilization is, it's the amount of credit you have available versus the amount you have, the bill you have outstanding, essentially, what you've used already. And it's a huge factor into your credit score.
It is. Definitely keep it below 30%. Keep it below 30%.
Yeah, if not lower.
Yes. And another thing that I realized too is not only credit cards and loans, but having a variety of different credit lent to you. So a mortgage and car loans, things like this, increase your score because you're not heavily concentrated in any one area. So when I truly started understanding this, I became better off financially because one, what I wanted to apply for, I knew I can get it if I was applying for credit because I kept my credit score up. But I understood how it was impacting me, decisions that I was making, then how it will impact what I want to do in the future.
And it's, pros and cons of the credit score system, but in the U.S., we're living with it, and you got to learn. When you're living in the system, you got to learn how to work the system. And keeping your credit score high, it does give you access to financial products and instruments and opportunities that if you don't have a good credit score, you're not going to be able to have access to. So.
And I'll say one thing I've kind of lived by, and I've told a few people, is given that we're so heavily focused on credit score and debt in this country, and just in general, is you don't have to make a lot of money in order to have what you want. As long as your credit score is good, and you have a great credit history, you can get anything that you want.
True. Yeah. I think speaking of financial literacy, I think there's a few other fundamentals that I would mention in addition to the credit score. Like, for me, number one is living below your means. Like, if you're gonna have a stretch goal to get an apartment or a house or whatever, make it a stretch goal, but be prepared to work to make sure you're able to afford it. But ideally, you want to be within your means, meaning the amount that you're earning should always be greater than the amount that you're spending on, whether you want to look at it on a monthly basis or a yearly basis. I think that's a fundamental. What are some other fundamentals, Deon, that you would say for as far as financial literacy goes, that people should be cognizant of?
Well, I would say that's number one is living below your means. And I will say another one is sacrifices that must be made in order for you to be financially independent. Because a lot of people want to get there, but a lot of people don't understand what that means. Financial independence to me means time, not money, but time. And what I mean by that is being able to do what I want to do when I want to do it.
Amen.
Is financial independence to me. So what that means is, sometimes I got to forego doing certain things I want to do for the bigger picture. So I'm giving up my time now and doing things I really don't want to do, but in the future I know it's going to pay off because if I want to go on vacation, I can go on vacation. If I don't want to go, I don't want to do anything today, I don't have to do anything today.
Right.
And that is the goal, is financial independence, which is time for me. But understand that you have to make sacrifices to get there. Not saying you have to, eat ramen noodles and, drink water all the time, but certain sacrifices will be made. A lot of times it's as simple as, if I'm going out 4 times a month, let me cut it down to 1 time a month. And to see how much more money you have in your bank account by not spending that money. Yeah.
Speaking of that, I met an Uber driver a month ago, and he was just telling me about his life. He was like, oh yeah, I'm getting ready. He's like, I'm only driving Uber for 3 more weeks. And I said, oh, that's amazing. What are you going to do next? And he's like, nothing. I'm going on my world tour. And I said, oh, wow, that's really cool. He said, I've worked 12 to 16 hours a day for the past 4 years. He's like, I have a full-time job. I drive Uber. I drive DoorDash. And I am going to be financially independent and ready to retire in 3 weeks. And I said, that is amazing. Talk about sacrifice. I mean, that's obviously an extreme, anecdote for that principle, but I thought it was amazing. He was, I think he was 35, 36, mid-30s, and was ready to fully retire and go live his dream of traveling the world full time. And, I thought that was amazing. If that's he set his mind to it and then he made it happen. Obviously, a lot of people won't take that to that extreme measure, but it just goes to show, he didn't have some extraordinary job that he was making millions a year. He just buckled down and sacrificed.
Yep. Which is brings up another great topic and point is financial literacy and kind of that movement of FIRE, which is financial independence, retire early.
Yep. My favorite is Coast FIRE.
What's that?
Coast FIRE is what I worked toward before I left banking, which is you have enough money in your retirement accounts that you can coast, meaning if I never contributed another dollar into my 401k and my TSP, I can wait and let it grow and retire. So I can retire at 60 without ever having contributed another dollar to my, assuming that, there's
Yeah.
not some Great Depression,
Yeah.
market crash, I can retire on that money. It'll be enough to give me the lifestyle that I want at retirement age.
Oh, see, you're teaching me new things. Never heard that before.
Yeah, and then a lot of people do co-spire, and they have different like age targets. So it's like, okay, I can co-spire, meaning I can retire at 60, and then a lot of people will co-spire to 55, to 50, and they'll just keep working, keep contributing, even though they don't have to. And there are calculators on the internet, obviously, that you can see like, oh, if I have this much saved today, and I know I need, $2 million to retire it at 60, like, can I get there? Am I there yet? So, and people will work to where they're actually FIRE, which is, I never have to work another day in my life. But there's some middle ground there, I think, which I think is exciting for people who are like, well, I kind of like working, or I don't mind working part-time, or, I like, freelancing, or I want to start my own thing. You don't have to like retire if you don't want.
Okay.
But your goal can be somewhere in between.
Awesome. As you were talking, I thought about one thing. You asked me some other tips about financial literacy earlier. I would say probably the outside of living below your means, probably the biggest one is you want to start early.
Yeah, that's a good one. Yeah.
Yeah, you want to start. The earlier you start, the better off you will be because time is on your side.
100%.
And interest compounding and all this stuff. When you think about, if you start when you're 20, if you want to retire at 60, you got 40 years of working to build up, and you're going to start seeing this kind of snowball effect that does happen. Is once you get to a certain threshold, you're going to see that the money that starts.
Yep, it's like avalanching.
Yes, it's avalanche. Yes, it is going to start on its own.
And that's what I attribute. Honestly, my co-spire status, I attribute to, I joined the military, joined the Navy when I was 18, and I didn't know anything about anything because my family, like you mentioned before, my family did not teach me because, a lot of them didn't know themselves, but I knew nothing about finances, investing, any of that, and the military forced me to open up to have a TSP, to contribute to it. They forced me to open up my first credit card at 18. They just told me it was a good idea. We had like this finance 101 boot camp in boot camp. And I started investing and contributing to my retirement when I was 18. And if it weren't for that, I don't know where I would be. It definitely made it a lot easier for me to just have the habit of contributing to my retirement monthly, to contributing to a savings account monthly, to having a longer credit history. Which I think all contributed to setting myself up for success. So if you're watching this and you're young and you're like, I don't know if I should start saving for retirement yet, just do it. Even if it's $5 every time you get paid. And if you're watching this and you're trying to set your kids up for a successful financial future, get them started early, get them started young, start teaching them about finances. I love teaching kids about taxes. When we were at KPMG, there was that volunteer organization.
Oh, yes.
You know what I'm talking? I can't remember the name of it. I wish I could shout them out, but we would go in for a day and teach students in elementary school about different financial concepts. And I'll never forget the day that I taught like third graders about taxes. They were literally outraged. They were like, "What? You're just gonna take my money?"
Yes, that first check, it hits you hard.
And it's adorable. So, teach them young, get them angry.
Yes.
Get them thinking strategically about how they can get their tax money back.
Oh, and you mentioned something. I don't think we let the audience know. Julie and I used to work together.
Yes,
and still do work together at
we
KPMG and
Guidehouse. Yes. Throwback.
Yes. Taking them back there. I want to say thank you for joining me today.
Thank you for joining the Positive Money Project.
Thank you for joining our financial literacy series, and I want to say thank you for your insights.
Of course, thank you.
If there's one thing that you can tell the audience about taxes, financial literacy, the economy, what would it be?
I would say be consistent. Use your resources. Use your family, your friends, like whatever it takes. Don't do it alone. And then once you get started, be consistent. When you have that support system around you, you have other people motivated and inspired to gain financial literacy, to exceed financially, to achieve financial independence, whatever that looks like for you. Build that system so you can stay consistent, and baby steps.
Awesome.
Yeah. What would you tell them, Deon?
Oh, okay. Flip the tables.
Flipping the script.
Okay. I guess the one thing I would say is just get started.
Yeah.
Like, you have to. Whether you're 18, whether you're 43 or in between, like, you have to get started.
Yeah.
Because ultimately, if whatever life you want, you have to get started at some point.
Yeah. And you're not going to know everything when you start.
Yeah, you're not going to know at all. And also with that, get started, but be willing to listen.
Yeah.
That's another thing that gets a lot of people in trouble, is they think they know it all and they won't listen to people.
Yeah.
And it makes it very hard when you're trying to break habits.
Being coachable is super important, for sure. Well, thank you so much, Deon. It was great talking to you today.
Thank you.
Bye.
Bye.